Warren Buffett said that if he had bought an index fund in 1942, the year he bought his first stock, with $10,000 reinvested dividends and never look at it again, he would have something like $51 million. Index funds are an amazing investment tool. Low fees, they're not actively managed, and they had pretty attractive returns for long periods of time. But do you know exactly what they are and how they work? Because if you don't, you may be losing a great opportunity. But the good news is I'm going to help you. Today we're going to talk about index funds to help you as a beginner to know more about it and to use this great investment tool. If you're new to my channel and you enjoy this type of content, hit the subscribe button and activate the bell for you to receive every notification of my videos. Every Thursday you'll have a new video, and every day you'll have amazing content on my Instagram. You'll have the link in the description. Well, the first question I think I should answer in this video is, what's an index fund? Well, I saw an analogy about index funds that I'm going to use to explain. If you're a fan of football, think about index funds as the classification table of the Premier League, for example. You have a lot of teams that are in that table. If they get enough points, they stay. If they don't, they will be relegated and out of the Premier League table. Index funds are the same thing, but switch the teams for companies. Let's use S&P 500 to explain this. In this index fund, you will have the 500 companies that have better performance in the US. If there's a company on S&P that's not going well, it will be replaced by another. S&P, for example, is rebalanced 4 times a year. So when you buy S&P 500, you're buying a slice of all the companies in that index fund. S&P on average has had a return of 10% since 1920. If you add inflation to those numbers, on average you get 7 to 8% of returns. I know these returns will not make you $1 million in a few years, but index funds were made with low fees for you to take the best you can out of the stock market without taking an enormous amount of risk. So what are the advantages of owning an index fund? With index funds you'll have a diversified portfolio, which is one of the most important rules to be successful investing. And you don't need to know every data about the company, and you won't take the risk of having a singular stock. You can invest for the long term without sacrificing your sleep. The compound effect will make you tons of money without you even noticing. They're not actively managed funds, which means you won't pay management fees. With index funds you're investing almost for free. Index funds have proven that even in bad times of the economy they will protect your money from big falls, because you own a slice of 500 companies and you will not be exposed to big losses. And if you're a competitive person, in the long term you'll be in front of most investors, and you don't even have to think about it again. And let's be honest, index funds are a great option for individual investors, because the average investor in the long term can't beat the market. Unless you're a unicorn like Warren Buffett or another shark of the financial world, you won't beat the market in the long term. Okay, now that you know the advantages of it, let's compare it with an actively managed fund. Are mutual funds an attractive investment? Well, for those who don't know, mutual funds are a company that gets money from investors and use it to invest in bonds, stocks, and other types of investments. If they're actively managed, they will charge you a big amount of fees, and of course that will impact your returns. Most of the time in the long term they underperform the market, so if you want to beat the market you would have to choose the winners, and that's not an easy task. Just for you to understand, it's rare for a manager that can outperform index funds for more than 10 years. It's almost unheard of in the financial world. With that said, even if it's only for the fees, index funds are worth it. Why do I say that they're probably the easiest way to make money on the stock market? Because it's the truth. You could just own an ETF that tracks, for example, the S&P 500, and you just hold it like forever. The biggest difference between buying an ETF or an index fund is that ETFs can be traded throughout the day like stocks, and index funds can only be bought or sold at the price set at the end of the trading day. If you invest in the long term, you should just buy and keep buying consistently what your income allows to. I'm not a financial advisor. I'm not telling you to own or not an index fund. As you guys know, I'm not allowed for that. And even if you own index funds, you don't need to only own index funds. You can still own individual stocks and have a good proportion of index funds on your portfolio. Index funds are an investment for the long term with predictable returns, so the proportion of individual stocks on your portfolio depends on your risk tolerance and your age. When you're younger, you probably have more risk tolerance because the time is on your side, and even if you make mistakes, you have the opportunity to correct those mistakes. If you're older and you want a peaceful retirement, you should probably own index funds and other types of investments with predictable returns. Investing doesn't have an instruction manual that works for everyone. At the end of the day, your investments should come down to 4 main factors. Risk of your investment. It doesn't matter if you think you'll turn $10 into $1 million if you can't sleep at night because your risk tolerance doesn't let you sleep. Make sure you're investing according to yourself. Secondly, have a plan. You can't just invest randomly and expect whatever it is. Make a plan and stick with it. If you don't know how to do it, get some help. Thirdly, what do you know about your investment? Don't shoot randomly to a singular stock or a new cryptocurrency. Make sure you have a reason to invest. And last but not least, define your goals investing. If you're about to retire, you don't have the same goals as a teenager that's starting his investments. Have financial goals and align your investments with your goals. We're not all the same, so don't try to invest as somebody else. Understand yourself. Well, and for now I finished my video here. I really hope you guys enjoyed it. This was Successology here. You'll never be average again. Peace.